In this video, I want to give you an update on the economic state of the union. I want to cover inflation. I want to cover the real estate market. I want to cover the potential looming recession. I also want to cover wages and the labor market. I want to cover credit card debt, and I want to cover the Federal Reserve and how its policies are affecting you and the economy. I also want to talk about the potential government shutdown that will occur in the next few days if the government and Congress cannot agree on a budget. At the end of this video, you should be up to date on everything that's going on economically in this country as of this quarter. So let's do just that. As always, my name is Derek, and I got my degree in finance, so you don't have to. Let's begin. So first and foremost, let's start with inflation. Inflation is still too high for the federal target rate of 2%. Both CPI and core inflation are above their targets, and inflation will probably remain this way for a little bit longer. Inflation is looking sticky in the 3% range. And remember, the Federal Reserve wants both core and CPI, but they prefer core inflation to be at their target rate. So this means that since inflation is high, the Federal Reserve policies will remain hawkish and not dovish. That means higher interest rates, which we will touch on here in a little bit. Before we do that, I want to cover the major problem that most Americans are facing right now, which is housing and housing affordability, which is directly related to inflation and the fight against it with interest rates. Right now, mortgages remain high. They remain above 8% in most instances, and prices also remain extremely elevated. The reason why prices remain elevated is because supply remains low, and this is a twofold problem. One, builders are not building enough to counter the demand. Secondly, sellers who would want to sell their house cannot because they are stuck with a 3 or 4% interest rate, and they understand that if they list and sell right now, they will have to buy their next house on a much higher interest rate. So you have supply pressures from both sides, the building side as well as potential sellers who cannot sell. So because of this, the monthly available homes for sale is down 15% for the year, and it will probably remain low until one of two things happens. One, inflation comes down, and two, interest rates which are being used to fight inflation also come down. This will allow builders to build, and it will also allow rate-locked potential sellers to sell. So the overall state for the real estate market, right now it is still extremely unaffordable, and it looks like it will remain so for quite some time. It is very, very much tied to the federal funds rate, which we will talk about in a little bit. So remember, real estate is tied to the federal funds rate because mortgages are tied to the federal funds rate, not directly, but indirectly. Okay, let's talk about a potential recession, which has been floated by a lot of people in a lot of places. Some people say there is a potential recession. Some people say there is not. I think that in reality, both of these people are right and both of these sides are wrong. Here's the thing. A recession is something technical, but what we feel is something else. So a technical recession is two quarters of negative GDP growth. Okay, that does not seem anywhere near a possibility currently, but that does not mean that the economic environment doesn't feel like a recession for the average American. So currently, GDP growth is extremely strong, and it is ripping red hot, especially for a mature economy like the United States. In order for a true recession to happen, we would have to go past growth into negative growth, and we would have to do so for 2 consecutive quarters. Right now, GDP growth year over year is above 4%. So a technical recession might not be in the cards, at least not in the next few months. Here's the problem. For you, the consumer and the worker, it can still feel like a recessionary environment even if we are not in a technical recession, and that has to do with wages, inflation, and affordability. Most Americans right now feel poorer than they did a year or 2 years ago, and because of that, it feels like a recession. So both of these camps, I think, are wrong and right. They're just looking at it slightly through the wrong lens. It might not be a technical recession, but it doesn't mean that we cannot still feel like we are in a recession. So the best place to lead from this would be to wages, because wages directly affect how the average American feels in regard to economic prosperity. So right now, year over year, as of September, so September 2022 to September 2023, wages have increased by 4.5%, which seems good. That means that if you made $100,000 last year, you might be making $104,000 this year. The problem is inflation. When you look at inflation, both core and CPI inflation are in the 3s and low 4 percentage points. The thing is, remember that both of those, both core and CPI inflation, are a basket of goods that are used to judge and gauge inflation. And the Federal Reserve cares more about core inflation, which removes energy prices and volatile food prices. The problem is you, the consumer, and me, the consumer, we feel CPI inflation more than we do feel core inflation because we have to fill up our cars and we have to buy food. On top of that, this basket of goods is not necessarily indicative of what you feel when it comes to inflation. For you, it probably feels much more than 4% when it comes to prices of everything over the last year. So even though salaries look to be increasing, okay, it doesn't necessarily mean that they're outpacing inflation. And if they are not outpacing inflation, you, the consumer, is still going to feel poorer. So even though the economy is growing and even though wages are going up, it doesn't necessarily mean that you are feeling that because of inflation and because it is outpacing wage growth. So remember that. And that those two kind of work very much together. A potential recession versus what we feel is a recession, and wages and wage growth. Okay, with that said, wages are growing, but the labor market is cooling, okay? That means that less jobs are being added on a month-to-month basis than expected. That is negative for you, negative for me, but positive for the Federal Reserve. Remember, the Federal Reserve cares primarily about inflation and nothing else. They do care, well, I shouldn't say nothing else. They do care about the economy, but they care primarily about inflation, and they will throw the economy under a bus if that is what is required to get inflation to where they want it. So they have two goals, they have a dual mandate, but they tend to favor the fight against inflation because price stability they know can get out of control and can harm Americans in the long term. At least that's what they say. So the labor market is cooling because they are putting interest rate pressure on businesses. Remember, the Federal Reserve is keeping interest rates high. The federal funds rate is currently at 5.5% to fight inflation. This, at the same time, also leans on the brakes and cools the labor market. They want to see this because a weaker labor market technically means less people with jobs, less salary going around, and less money being spent into the economy, which in theory should cause businesses to halt or lower prices, which means that the overall inflation rate will come down. Okay? The other thing that we have to remember, the Fed is not after deflation. It is only after inflation control. So while in certain pockets of the economy, prices might come down, the overall price of things is not going to come down. They do not want that. They do not want deflation. So the prices that we see right now are the prices that we're going to get. And they're not going to get cheaper in the future. They're going to get more expensive. They're just going to get more expensive at a slower rate, which is what the Fed wants. So when it comes to all this, now we need to lead into the Federal Reserve policies, because the Federal Reserve has extreme policy-making ability and can control the economy extremely. They have a great deal of control over the economy. The problem is a lot of the problems and issues that we are facing right now economically have to do directly with the Federal Reserve's policies 3 years ago in 2020. The Federal Reserve printed a ton of money, and I can do another video because I think people get misconstrued on what printing money actually means. In a few seconds, printing money is the Federal Reserve creating bank reserves onto an imaginary balance and then purchasing treasury bonds and mortgage-backed securities to inject liquidity into the market. They're not actually printing dollar bills, okay? But the Federal Reserve, in essence, printed money in 2020. That money coupled together with the federal government's programs of stimulus, okay? So remember, stimulus is government borrowing. Quantitative easing is money printing, and they work together to stimulate the economy during 2020 and 2021, where the economy was artificially shut down. Okay, I'm not here to argue whether those policies were correct or not. This is what happened. The problem is The Federal Reserve pumped just a little bit too much money into the economy, and the US government probably handed out just a little bit too much money in the form of stimulus checks and PPP, which is payment protection programs. And now, 3 years later, we are paying for those consequences because now we have high inflation that was caused directly by those things. So the Federal Reserve is, in a sense, playing catch up with its policies that it enacted itself to try to stimulate the economy. Now it is trying to keep inflation down, which those policies definitely cause, by raising interest rates, which we end up in the environment that we are, which is a high interest rate environment and a high inflation environment, and that is why we're dealing with what we're dealing. So we have talked about most of the economic things when it comes to the U.S. economy. What I want to touch on now is the potential government shutdown, because while this is not directly tied to the economy, it has consequences that might affect the economy, and that is usually has to do with borrowing money. I'll talk about that here in a second. First and foremost, so you understand what's going on. The government last minute averted a government shutdown about 45 days ago. They managed to push through a bill that allowed for a budget for the next 45 days to be implemented. The problem is that those 45 days are almost up. Okay. Remember, every year, the government, Congress has to publish and agree on a yearly budget. If that does not happen, the government shuts down. Right now, you have infighting, mostly in the GOP party, but I'm not going to blame one or the other. The politicians in general tend to fight all day long. So you have infighting, which is not allowing a budget to be passed. If a budget is not passed in 5 days, the government shuts down. Okay. We've had government shutdowns in the past. Okay, the longest one was actually just a few years ago, right before the pandemic, which I don't even know if I can say that on here. We will get through a government shutdown. We always do, and people tend to blow it out of proportion every single time. The government doesn't shut down. Just essential services continue, everything else does not. Or people are working, government employees are working without pay. They will be paid eventually, but in the short term, it can slow the economy because there is less cash going around. The more important problem that this signifies is not really anything that has to do with economics. It is more so, it shows a lack of cohesive governance from our leaders. And guess who does not like to see that? Credit rating agencies and lenders, because a lack of cohesiveness with the government means that they are at greater risk of default or not agreeing to pay their debts. So what happens? Well, basically, one, credit rating agencies lower the credit rating of the United States government. Two, lenders are going to charge the government more money to borrow because they see that the government is more risky. That hurts us directly because we, the taxpayers, pay for the government debt. Okay, the national debt is above $33 trillion at the time of this filming. We, the taxpayers, have to pay that debt. Currently, it is about $600 billion every single year just on interest payments alone. If the credit rating goes down, those interest payments go up, which means more of your taxes and my taxes go to servicing the national debt and not to paving roadways and schools where it should go. Okay, so here's the problem. Standard & Poor's, there's three major credit rating agencies. There's Standard & Poor's, there's Moody's, and there's Fitch, okay? Standard & Poor's already downgraded the U.S. credit rating more than a decade ago in 2011, okay? For very similar reasons. They cited a huge national debt and an increasing national debt, which we are still dealing with over a decade later. Okay, then just a few months ago, Fitch, another of the three largest credit ratings, downgraded the U.S. credit rating. They cited the lack of cohesive governance as one of the major reasons, okay? Now, Moody's is the remaining one that has given the U.S. government the top tier rating, okay? They, just a few days ago, issued a warning that the U.S. debt is becoming more risky for various reasons. One, the growing debt, and two, the lack of cohesiveness in the government. So, if we have a government shutdown, that shows that the government is not working well together, which may trigger Moody's, the remaining one that is giving a top-tier credit rating to the U.S. government, to downgrade the U.S. government. That would be 3 for 3. That would cause problems, and that would cause an increase in the cost to borrow money for the U.S. government, which will directly affect you and me. the American taxpayer. So we've covered pretty much everything that needs to be covered for this current State of the Union economically and for this current quarter economically. Now we are moving into the end of 2023 and we are moving into 2024. So I want to give you a few of my own predictions as well as the predictions of experts. So I'm not just pulling this out of thin air. This is based on data. So let's talk about interest rates first. Interest rates are going to remain high through 2024. That is almost a guarantee. Regardless of when the Federal Reserve starts to cut interest rates, we are not going to see cheap interest rates for a long time. And the sub 3% interest rates that most people are accustomed to when it comes to mortgages are probably not going to come back for quite some time. The general consensus is that the Federal Reserve will start cutting interest rates, the federal funds rate, quarter 2 to quarter 3 of 2024. Okay, the problem is that does not change overnight. They will start cutting and they will cut slowly. So it'll go from 5.5 to maybe 5.25 to 5 to, and they will go very slowly down. They will not just cut overnight an extreme amount. So what does that mean? That means that every meeting they might cut a little bit, which means that there's going to be a lag, which means that to truly see any sort of meaningful change, if they're not going to start cutting until quarter 2 or 3 of 2024, we are not going to see reasonable changes in credit card loan rates, in auto loan rates, and in mortgage rates until probably the end of 2024. In reality, probably not until 2025. There is an estimate that the federal funds rate will not be below 4% until the end of 2024. So interest rates will remain high. When it comes to the real estate market right now is not in a good place because one, affordability is non-existent, but two, prices are remaining high. And that will not change until interest rates come down. So the real estate market is going to remain in this weird, unaffordable place until interest rates come down and builders can start building and sellers who want to list can start listing. The problem is when interest rates come down, what happens? You spur up demand, right? Because interest rates come down, that means more people can purchase homes. So it is a very tricky situation. I'm not going to make some overarching prediction. I don't have a crystal ball. I'm not God. I do not think I'm the smartest person in the room. I can always learn something from you, just like I hope I can share something with you. So if you have a different opinion, let me know. But I think real estate is going to remain unaffordable or expensive through 2024. That's just the unfortunate fact of the matter. Inflation will probably start to come down and hopefully stabilize by the end of 2024. Hopefully we should be trucking along very close to our 2 to 3% target. Well, not my target, but the Federal Reserve's target of around 2%. We should be below 3% by the end of 2024, which will be good because that means the Fed can cut and hold interest rates lower. So inflation will remain high, but should start to come down. Real estate will remain unaffordable probably through 2024. A potential recession, an actual technical recession, still doesn't look like it's in the cards, although with a weakening labor market, it could, but it most likely will remain more so an environment that feels like we're in a recession. Okay, wages will probably continue to trickle up. You just have to remember, wages are an expense to most companies, and they are a revenue to you. So there's always a conflict of interest. Even if wages continue to increase, you're going to continue to feel poorer until inflation comes down below wage increases. So if wages are increasing by 4% next year, inflation needs to be below that for you to feel any semblance of richer. And then the government shutdown. We'll just have to wait and see what happens with that. If the government does shut down, I could totally see Moody's downgrading the U.S. credit rating. If the government does not shut down and manages to avert a shutdown, I think it's 50-50. I think Moody's could downgrade or it could hold it stable. The problem is there is a debt crisis here. And the Federal Reserve has way too much debt. The United States as a nation has way too much debt. And if on top of that, we can't manage to agree on a budget, I could see a credit downgrade. I hope this video was informative. I hope this video was also educational because the economy is so many moving parts. It's a ton of moving parts, and all of them are at the same time interconnected, but also independent of each other, and it can get very confusing. The fact of the matter is the economy that we are dealing with right now is heavily reliant on low interest rates because it was built over the last decade on low interest rates, which is why we're experiencing lots of problems with high interest rates. But other than that, I hope this video was informative. I hope you learned something. If you did, please consider subscribing. This is a relatively new YouTube channel, and it's something that I'm very passionate about, and I love to share with you guys. So If you haven't already, please subscribe and turn on the bell notification so you don't miss the next video. Usually new videos are on Tuesday, but sometimes I'll do a video on Wednesday, Thursday, or Friday, or Saturday if something major comes out, like a credit downgrade, or like a Federal Reserve meeting that needs to be talked about, or something that you need to know. So if you want to stay up to date about world economics, personal finance, investing, etc., you're in the right place, and I hope to see you in the next video. Until then, take care.